In this video, I've created the ultimate guide to mastering order blocks. We'll cover everything from the basics to advanced techniques. Whether you're just starting out or already an experienced trader, make sure to watch the whole video to fully grasp each concept. I'll also share 3 high probability trading strategies using order blocks. By the end of this guide, you'll have a solid understanding of how to use order blocks for consistent profits. This video is a complete masterclass on trading with order blocks. Let's jump in and go over the topics covered. Let's start by understanding what an order block is. An order block is a key zone on the chart where a large amount of money has been traded, often by big institutions or banks, also known as smart money. Because they trade with huge capital, their actions can create noticeable price movements. So when you see a sharp price move from a certain area, like this one, it might be a sign that smart money has made a move. Large buy orders push the price up quickly, and the area where these trades happen is called an order block. There are 2 types of order blocks: bullish order blocks, which are created by large buy orders, and bearish order blocks created by large sell orders. In this video, I'll show bullish order blocks in blue and bearish order blocks in purple, but you can use any colors you prefer. Once you've identified an order block, it can create potential trading opportunities because the price often retests and bounces when it hits that area. For example, if you had bought at the order block here, you could have made some good profits. Now, you might be wondering, isn't this the same as support and resistance? While both order blocks and support resistance are important levels, they aren't the same. There are some key differences between the two. The first difference is how they are formed. Order blocks are created when there's a significant price movement from a specific area. For example, if the price moves sharply from a point, you can mark it as an order block. On the other hand, support and resistance levels form after multiple price rejections. If the price gets rejected at a certain level once and again at the same spot later, you can mark that as a support or resistance level. The second difference is how they are drawn on the chart. Order blocks are usually shown as thick zones or areas, while support and resistance levels are typically drawn as thin lines. Even if support and resistance are drawn as zones, they're much thinner than order blocks. The third difference is how often they are retested. Order blocks are usually a one-time use level. Once the price retraces to the order block, it's done and can't be used again. In contrast, support and resistance levels can be retested multiple times. Although order blocks and support resistance are different, they can be used together. For example, if an order block forms at the same time the price is near a resistance level, this is called a confluence. Finding a setup with confluence is ideal because the price has a higher chance of reacting to that area. Before we can start trading with order blocks, we need to know how to identify them correctly. Earlier I mentioned that if the price moves sharply from a point, you could mark it as an order block. But it's not that simple. A big price move doesn't always mean there's an order block. There are specific rules to follow to confirm whether an order block is valid. Here are the 3 important rules for identifying a valid order block. These rules are crucial because you won't be able to trade the strategy successfully without understanding them. Rule number 1, for a price move to be classified as an order block, it must create a gap afterward. This gap is often called inefficiency or imbalance. Whenever you hear these terms, they're simply referring to a gap. Let's look at an example to make it clearer. We have 2 similar upward price movements. However, notice the key difference. On the left, there's a gap between the first candle's upper wick and the third candle's lower wick, while on the right, the wicks intersect with the candle bodies, so there's no gap. This gap is what we call inefficiency or imbalance. Even though both setups show significant upward movement, only the left one is a valid order block because it has inefficiency. To draw the order block, take the first candle before the inefficiency and draw a rectangle from the top wick to the bottom wick. Rule number 2. An order block must be unmitigated. Order blocks are typically a one-time use level. If the price touches an order block, it's no longer considered valid, meaning it can't be retested. For example, if you spot a gap or inefficiency and draw an order block, but then see the price or even just a wick touching that order block. It's no longer valid because it's been tested. While there are strategies to reuse a tested order block, I'll cover those later in the video. For now, just remember that an order block is generally only usable once. Rule number 3. The most important rule is that an order block must lead to a break of structure or a change of character afterward. If you're not familiar with these terms, don't worry, I'll give a quick recap. Let's simplify this. Markets move in trends, either uptrends or downtrends. In an uptrend, the price doesn't go straight up. It moves in a structured way, creating what's called higher highs and higher lows. Higher highs means each high point is higher than the last one, and higher lows means each low point is also higher than the last. In a downtrend, it's the opposite. The market forms lower highs and lower lows, where each high is lower than the previous one, and each low is also lower. In an uptrend, when the price breaks above a previous high and creates a new high, that's called a break of structure. But trends don't last forever. Eventually, the market will change direction. This shift happens when the price breaks below a previous low and forms a lower low. This is known as a change of character because it signals a shift from an uptrend to a downtrend. The same cycle happens in a downtrend. The price makes lower highs and lower lows, and when it breaks a previous low, that's a break of structure. If the price breaks above a previous high and forms a higher high during the downtrend, that's another change of character, signaling a shift back to an uptrend. So that's a quick breakdown of what break of structure and change of character mean in market trends. So how does this all connect to order blocks? For an order block to be considered valid, it must lead to either a break of structure or a change of character afterward. Let's look at an example. In this chart, we see a strong upward move along with a gap, also known as inefficiency, which suggests a potential order block. But we can't just mark the order block immediately. We first need to see if the market creates a break of structure or a change of character. Once the price finally breaks above the previous high, creating a break of structure, we can then draw our order block on the first candle before the inefficiency. Similarly, we see another significant upward move with inefficiency, followed by a break of structure when the price forms higher highs, which confirms another valid order block we can draw. Let's go over another example. In this chart, the price is creating higher highs and higher lows, and we have a potential order block here due to the inefficiency. However, since the price hasn't made a new higher high yet, we can't consider this a valid order block. After some time, the price moves down and forms another possible order block, but this time it's a bearish one. We see a significant downward move with inefficiency on this red candle. Then, the price breaks the previous lows, forming lower lows. This break counts as a change of character because the market has shifted from an uptrend to a downtrend. Now, we'll focus on the most recent bearish order block as it aligns with the new downtrend. The earlier bullish order block isn't valid because the price didn't create higher highs, but the bearish one is valid since it led to a change of character. In this video, we'll explain order blocks in a simple way. First, we see the price moving up significantly along with some inefficiency, which could suggest an order block. However, because there hasn't been a break in the structure yet, this order block isn't valid for now. Later, the price moves down and then back up, creating more inefficiency, indicating another potential order block. This time, the price makes higher highs, but within a smaller structure, making it a valid order block for that structure. If we zoom out, we can also see the price made higher highs in the larger structure, meaning the earlier potential order block has now become valid too. So when drawing order blocks, it really depends on the structure you're looking at. To recap, the 3 rules to identify a valid order block are: 1. It must create a gap, also called inefficiency or imbalance. 2. It must remain untested or unmitigated. 3. A break of structure or change of character must happen afterward. Learning to spot order blocks is a great skill, but the real fun starts when you apply them to your trading strategy. Now I'm going to reveal 3 order block strategies that can elevate your trading. Strategy 1, multi-timeframe confirmation. For this first strategy, start by identifying an order block on a higher time frame. In this example, we're using the USD 4-hour chart. We notice 2 key price movements, one going up and the other going down. Both movements show inefficiencies, meaning we have 2 possible order blocks, one bullish and one bearish, but we need to confirm if these order blocks are valid. For the bullish order block, the price moved upward with inefficiency, but it didn't create a clear break in structure. Also, the price retested it, so it's no longer unmitigated. For the bearish order block, the price made lower lows, creating a break in structure, and it's unmitigated. So based on this analysis, only the bearish order block is valid. Once you've identified the valid order block, wait for the price to retrace back to that level. When the price touches the order block, move to the next step, confirmation. We need to confirm if the price will bounce off this order block. To do that, switch to a lower time frame like the 15-minute chart. On the 15-minute chart, look for signs of bearish momentum to see if the price will reverse from the order block. You can use various confirmation tools, such as indicators like the MACD, bearish candlestick patterns, or a change in market structure. My favorite confirmation tool is the bearish engulfing candlestick pattern. It's simple but effective. A bearish engulfing pattern occurs when a smaller bullish candle is followed by a larger bearish candle that completely engulfs the previous one, signaling a potential reversal. Once you spot this pattern, open a sell position after it forms, place your stop loss just above the order block, and set your take profit at 2x the size of your stop loss. This strategy can lead to strong profits. Here's a cheat sheet for using multiple time frames. If your high time frame is the weekly chart, use the 4-hour chart as your low time frame. If your high time frame is the daily chart, use the 1-hour chart as your low time frame. If your high time frame is the 4-hour chart, use the 15-minute chart as your low time frame. If your high time frame is the 1-hour chart, use the 5-minute chart as your low time frame. And that's all you need for strategy 1. Strategy 2, inducement traps. An inducement trap is a setup where a smaller key level forms near a major order block. For example, imagine a major order block forming below and a minor key level forming above it. This minor key level, often referred to as an inducement, may experience multiple rejections. The strategy is called an inducement trap because in many cases, the price breaks through the minor key level only to retrace down to the major order block before reversing back up. Traders who bought the minor key level expecting a bounce are often stopped out when this happens. To use this strategy, when you spot a minor key level above a major order block, you can place a buy order in the middle of the major order block. Your buy order will only be triggered if the price touches the order block, giving you a high reward trade. If the price doesn't reach the order block, no position is opened and there's no risk. While this setup may seem random, it's actually quite common, and there's a logical reason it works. Large institutions, or smart money, want to enter the market at an ideal price, but because of their massive capital, they can't do so without moving the price. Unlike retail traders, who can enter positions easily, large institutions face the problem of pushing the price up if they buy all at once, which makes their entry price higher. To avoid this, they use inducement levels. After creating an order block, they push the price back down to the order block by triggering the stop losses. This is of traders who bought the inducement level, expecting a bounce. These stop losses often sit just below key levels, so only a little selling pressure is needed to trigger them, causing more selling. This allows the institutions to re-enter at the lower price, driving the price back up. Now let's look at a real example. In this chart, the price moves sharply upward, creating inefficiency and breaking the structure, which makes this a valid order block. After the upward move, we see an inducement zone where the price forms multiple rejections at a support level. Since there's a major order block below and a minor support level near it, this could be a potential inducement trap. In this case, we place a limit buy order in the middle of the order block and wait. As expected, the price moves downward, breaks through the inducement level, and triggers our buy order at the order block. Once the order is triggered, we set a stop loss just below the order block and aim for a take profit that's 2 to 3 times the size of the stop loss. You could also target the inducement zone for your take profit. As you can see, this trade turned out to be profitable. Strategy 3. Breaker blocks. In the beginning of this video, we talked about how order blocks are usually used only once. However, there's a way to take advantage of broken order blocks, and this technique is called breaker blocks. So what is a breaker block? A breaker block is a previously valid order block that has been broken by the price. Once this happens, the price may retrace back to that level, which can then act as a resistance zone where the price might reject again. This gives us a chance to enter a short position at the breaker block. Keep in mind that breaker blocks are typically only effective once. After the price breaks and retests the level, its usefulness usually ends. Let's break down an example. In this chart, the price moves sharply upward, creating inefficiency and making higher highs. This allows us to mark an order block. However, the price then moves downward, breaking the order block. This also causes a change in character, meaning the trend has shifted from bullish to bearish as the price breaks below previous lows. As the price retraces back toward the previous order block, this level now acts as a potential resistance zone. This is an ideal area to open a short position. Place your stop loss just above the breaker block and set your take profit at twice the size of the stop loss. In this example, the price rejected the order block, hit our target, and resulted in a solid profit. Now that you know these strategies, it's time to put them into action. However, if you're a total beginner with no trading experience, I recommend starting with a simpler strategy. To help you get started with order blocks trading, I've provided the order blocks all-in-one indicator that you can easily use on your trading platform. The order blocks all-in-one indicator marks different types of order blocks on your chart, like unmitigated, mitigated, and breaker blocks. This helps you see the market structure more clearly by showing these areas as colored boxes with labels, making it easier to spot potential reversal or continuation zones. In this video, I've also included a template that you can upload directly to your chart. It will automatically set everything up for you, so you don't have to worry about it. You can find the down link in the description. Check out my other video where I explain an easy strategy that any beginner can use to start making consistent profits. Thanks for watching, and I'll see you in the next one.